I can calculate the motion of heavenly bodies, but not the madness of people. Those are the words of Sir Isaac Newton, the man who discovered gravity, invented calculus, and decoded the laws of the universe. He was arguably the most brilliant human being to ever walk the earth. Yet in the year 1720, this titan of logic was utterly destroyed by a financial sultan's trick so seductive it nearly toppled the British Empire. We like to think that bubbles are for the uneducated or the greedy. We tell ourselves that in 2026, with our algorithmic trading and instant information, we are too smart to be fooled by a hollow promise. But the story of the South Sea bubble proves the opposite. It proves that when the mirror of money starts to warp, even the greatest minds in history can be blinded by the reflection. This isn't just a story about a bad investment. This is a forensic reconstruction of the debt-to-equity swap, the very same accounting magic currently propping up our global financial system in 2026. Because if the man who discovered gravity couldn't escape the pull of a collapsing bubble, what chance do you have? To understand the South Sea bubble, you have to understand the hidden hunger of a government in debt. By 1711, Great Britain was drowning. Decades of war with France had left the treasury empty and the national debt at a staggering £10 million, an impossible sum at the time. The government was paying 6% interest, and they couldn't afford it. They needed a reset. They needed a way to make the debt disappear without admitting bankruptcy. Enter the South Sea Company. On the surface, it was a trading company granted a monopoly on all trade with South America. In reality, it was a giant debt laundering machine. The plan was simple. The government would allow people to trade their government debt, bonds, for shares in the South Sea Company. The modern echo. In 2026, we see this exact same alchemy in the form of debt monetization. When the Federal Reserve buys trillions in government bonds to keep interest rates low, they are essentially swapping bad debt for new money. We've convinced ourselves that as long as the stock market keeps going up, the national debt doesn't matter. We are trading the stability of the currency for the illusion of growth. What happens when the trading company has no actual trade? The South Sea Company had one major problem. It didn't actually do any business. Spain controlled the ports in South America, and they weren't about to let the British in. In its first several years, the company barely sent a single ship. But that didn't matter to the directors. They weren't in the shipping business. They were in the narrative business. They spread rumors of mountains of gold in Peru and silver mines in Mexico. They told the public that the South Sea trade was the new frontier of human wealth. By 1720, the narrative took over reality. The company proposed taking over the entire British national debt. To do this, they needed the stock price to rise. The higher the stock price, the less equity they had to give the government to pay off the debt. The modern echo. This is the 1720 version of forward guidance. In our era, we see companies with zero profit valued at hundreds of billions because they are the monopoly of the future. Whether it's space exploration, EV charging networks, or generative AI, we are buying the story before the product exists. And just like the British public in 1720, we've stopped asking for the balance sheet. We only want the pitch deck. In January 1720, South Sea stock was trading at £128 per share. By June, it hit £890. By August, it reached £1,000. The madness was total. Everyone from the king's mistresses to the street sweepers was buying in. This was the great equalizer. But the most famous investor was Isaac Newton. Newton was a cautious man. He bought in early, saw the price double, and sold his shares in April for a £7,000 profit. A fortune in those days. He had won the game, he had seen the bubble and exited. But then the most dangerous psychological force in finance took hold, FOMO, fear of missing out. Newton watched as his friends and neighbors, people who couldn't solve a simple quadratic equation, kept getting rich while he sat on the sidelines. The mirror was showing him a world where his genius was worth less than his neighbor's luck. In June 1720, at the very peak of the mania, the man who defined the laws of motion jumped back in with both feet. He invested nearly his entire life savings at the highest possible price. The modern echo. This is the retail trap of 2026. We see paper millionaires made in weeks through meme coins or speculative tech options. Even the most disciplined investors, people who have spent a lifetime studying the markets, eventually crack under the pressure of watching the madness succeed. We forget that in a bubble, the only thing more expensive than being wrong is being right too early. When the sultan's trick is exposed, who gets to the exit first? The directors of the South Sea Company knew the end was coming. To keep the price up, They had started lending people money to buy their own stock. It was a circular Ponzi scheme of epic proportions, but they made a fatal mistake. They became jealous of smaller bubbles. Dozens of copycat companies were springing up, companies for making salt water fresh, for improving the soap trade, and the most famous one, a company for carrying on an undertaking of great advantage, but no one to know what it is. The South Sea directors used their political influence to pass the Bubble Act, which made these smaller companies illegal. They thought this would force all the capital back into South Sea stock. Instead, it triggered a crisis of confidence. People started to realize that if the small bubbles were hollow, the big bubble might be hollow too. They started to sell. The modern echo. In 2026, we see this in the regulatory crackdown. When the government starts picking winners and losers in the tech space, or when they try to ban competing private assets like Bitcoin to protect the official digital currency, they often accidentally trigger the very collapse they are trying to prevent. They expose the fragility of the entire mirror. The collapse was instantaneous. Between September and December 1720, the stock plummeted from £1,000 to £124. Isaac Newton lost £20,000, roughly $5 million in today's money. He was financially ruined. He spent the rest of his life forbidding anyone to even mention the word South Sea in his presence. The carnage across London was total. Families were evicted, merchants committed suicide in the streets, members of parliament were found to have been bribed with fake stock to pass the laws that fueled the mania. The British government itself almost collapsed under the weight of the unpaid debt. The final echo. As we look at the 2026 global economy, we see the same debt-to-equity structure. Our governments have debt they can never pay back. Our stock markets are the equity being used to distract the public. Our central banks are the directors providing the leverage to keep the prices high. Al-Ghazali's warning is louder than ever. A society can survive poverty, but it cannot survive corruption. The South Sea bubble wasn't a failure of math, it was a failure of honesty. It was a sultan's trick that used the prestige of the state to sell a lie to the people. We are currently witnessing the largest debt-to-equity swap in human history, as the national debt mirrors the Seljuk Empire's collapse, and the tech bubble mirrors the Harlem Tulip crash. What will be the Bubble Act of 2026 that finally brings the mirror down? Will it be a sudden hike in interest rates, a global cyber attack on the digital exchanges? Or will it simply be the moment when the people, like Newton, realize that the undertaking of great advantage has no one at the wheel? Don't let the narrative blind you to the numbers. Even the man who invented calculus couldn't beat a broken mirror. Watch the echoes. Stay wise. Because gravity always wins in the end.
History does not just repeat, it rhymes. So make sure you are listening for the next Money Echoes. Subscribe, and I will see you in the next one.